This alternative approach is what's taught at the Columbia School of Business, which is what Warren Buffett attended and was really used and taught by Benjamin Graham as an alternative method for calculating what the intrinsic value of an investment is in order to determine if an investment is a good one or not. This method does not depend on the calculation of an intrinsic value of a stock, but rather looks at the rate of return that's available to us as investors. So we're not trying to calculate the intrinsic value of a company. What we're trying to do is to determine the rate of return as an investor in making an investment. So I'll show you what I mean. There's three components that triangulate on one another using this method. So we have three models that we're going to run that are easy to do, relatively speaking. One is the earnings projection model. So that's the first model we're going to use. The second model is called the return on equity projection model. And the third is going to be, what I like to call the return on capital projection model. So we can, if I open up Paint here, I'll show you the three models. So the first model is called the earnings per share projection. The second model is called the return on equity projection. And then the third is the return on capital projection. Now, what we're doing with these models is we're triangulating these two and giving us a rate of return in the form of a percentage. This will give us a rate of return, and then we average these two out to give us our final rate of return. We compare this rate of return to the rate of return that's available to us in an alternate investment, like investing in an index fund. An index fund, let's say on average, would give us a 10% annualized rate of return. We want a margin of safety, meaning we want this number here to be 20% or greater. We're going to go step by step through this. It doesn't require Excel. It doesn't require a huge bunch of estimates. It doesn't require combining a terminal value with the future discounted cash flows to give us a whole bunch of nonsense. It doesn't require complex spreadsheets that make you look smart but really reveal your stupidity. Instead, what we're going to be doing is we're going to be breaking it down. Three different models that triangulate on one another and give us a projected rate of return. Again, this is the method that's taught at the Columbia School of Business Value Investing course that was founded by Benjamin Graham and is a much superior method to calculating whether or not something's a good investment. So let's start with number one, which is our earnings per share projection model. We're going to be using Google as our example in this case. I have Y charts open here. In our earnings per share projection model, what we're trying to do is project out the earnings per share of Google 10 years out into the future, conservatively. So we're taking the current earnings per share of Google, provided that those earnings per share are normalized and diluted. So we're taking the normalized and diluted earnings per share of Google, projecting them out 10 years, and applying a multiple that's equal to the growth rate. I'll show you what I mean. So on Y charts here, I take the earnings per share normalized and diluted over the last 12 months, so trailing 12 months, and I take it provided that it's not an abnormal number. So I don't want any crazy spikes or any crazy drops. If that's the case, then I take the average. But if I see that it's in congruence with the previous rate of growth, then I simply take the trailing 12 months earnings per share. So keep in mind here, we are doing this earnings per share projection model. I'm going to run it over here for you. You can see this, you can do basically all of these in your head. However, I'm going to be doing it here on Paint just to show you it doesn't require Excel or any huge computing power. So we take our earnings per share of Google, which is 5.17, so $5.17, so 5.17. And what we're going to be doing is we're going to be growing this using a conservative growth rate out 10 years. So let's grow it out 10 years. First, we need to find our growth rate. Now, there's a number of ways to figure out what this growth rate is going to be. I personally like to take revenue growth, knock off 25% off of it. So like Google's revenue growth, let me show you here. So I take the 10-year revenue growth, for example. So Google's 10-year revenue growth was 21%. And what I do is I just take 75% of that number. So I want to be conservative. And revenue growth is almost always slower than net income growth. If net income growth was slower, then I'd use the net income growth. But Google's net income growth is way higher than its revenue growth. So I'm using revenue growth because it's conservative. We're going to take 16% as our growth rate. So Google's growing its revenues at 21% per year over the last 10 years, but we're going to be conservative and say it's only going to grow it out at about 16%. So we're going to be conservative with this. So let's go back to our paint. We said that the trailing 12 months earnings per share was $5.17. Now we know that they're going to grow at 16% per year, conservatively, over the next 10 years. And keep in mind, throughout this, I'm just assuming that you did your evaluations on Google or any company. You've already determined that it's a good investment and this and that in terms of, the qualitative factors and, its potential room for growth and so forth and its management. This is just looking at valuation. So, we're going to grow this number out, $5.17 at 16% per year. And I just do it like this, just to keep it nice and easy. I do this 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we get a future earnings per share of Google of $22.81. $22.81. Let me just go back and double check that. So we had $5.17 growing at 16% per year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. $22.81. Now what we're going to do is we're going to take this number here and come up with a P ratio. I like to use P ratio that's equal to the growth rate just because it's super conservative. Some people take twice the growth rate. Some people take 1.5 plus 5, this and that. I personally just take the growth rate most of the time because it's the most conservative number and it doesn't require any really fiddling around. So our future earnings per share are $22.81 in 10 years. So we're saying in 10 years time, Google will be making $22.81. Now to figure out the price, we need to multiply this by the P ratio. I always say the P ratio should be equal to the growth rate, so times 16. So we're going to take this times 16 and we get a future price of Google in 10 years time, estimated conservatively, remember, of $365. $365. So what this is saying is that in 10 years time, Google's price will be $365. That's what we're saying, conservatively. Now, what we need to look at is we're gonna triangulate this number with our next method. Our next method is going to be our return on equity projection model. So over here on this side, what we're going to do is we're going to come up with another future price target of Google using a completely different method. So we're going to figure out what the future earnings per share are, but not by projecting out the earnings per share. What we're going to do instead is we're going to project out the book value per share, and then using Google's return on equity, figure out what its earnings per share is, and then use the same multiple that we use in this, which is 16. So I'll show you what I mean. Let's go back to Y charts. Let's figure out what Google's book value per share was. So book value per share of Google, and we can see that it's $19.55. So let's go back to Paint. So Google's book value per share currently is $19.55. That's what its current book value is. What we need to do is project out its book value 10 years from now, conservatively, using its book value growth. So we can look here, book value growth, and see what Google has grown its book value at over the past 10 years. And we see that Google's grown its book value at about 16% per year. So we're going to use that number. Going back here, we're going to grow Google's book value at 16% per year, which coincidentally is the same that we grew our earnings per share at, but that doesn't always have to be the case. So let's grow Google's book value out at 16% per year. So $19.55 is what its book value per share is currently. Let's grow that out Let's grow that out 10 years into the future at 16% per year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we're saying in the future, Google's book value per share will be $86 per share in 10 years' time. So keep in mind, its current book value per share is $19.55. We're going to grow it out at 16% per year, which is what Google has grown its book value out at over the past 10 years. So we're projecting out now 10 years into the future and saying in 10 years' time, Google's book value per share is going to be $86 per share in terms of its book value. Now what we're going to look at is what Google has managed to return on its equity over the last, let's say, 5 years on average. Over the last 5 years, Google has returned 21% on its equity, meaning that if Google's future book value is $86 per share, and Google manages to earn 21% on its book value in the form of earnings, then what we do is we take this $86 per share in terms of book value, and Google's able to earn 21% in terms of earnings on it, so we can project that Google's future earnings per share using this earnings per share projection model is $18.60 rather. So what we're saying, keep in mind, using this return on equity projection model, is Google's current equity per share, or book value per share, is $19.55. It's able to grow its book value at 16% per year, meaning in 10 years' time, Google's book value per share is going to be $86 per share. If we assume that Google is able to continue to maintain its return on equity, which is the average return on equity over the last 5 years, and we can see that Google has a good history of returning equity roughly at the same rate of about 20%, then what we can do is we can say that or 21%, if Google returns 21% on this future equity base per share, then it should be able to earn $18.60 per share. Meaning, if we now have a future earnings per share of $18.60, we can multiply it by the same multiple that we used here and get a future earnings per share, $18.06, multiply that by 16, and we get a future target price of Google of $289. So now we have two future prices for Google in 10 years' time. Using our earnings per share projection model, we estimate that Google will be trading at $365 in 10 years' time. Using our return on equity projection model, we estimate that Google will be trading at $289 per share in 10 years' time. If we average out these two, we get a conservatively estimated future price of Google in 10 years' time, coordinated between two separate models that gives us a good future price. So 365 is what we predicted with our earnings per share projection model. 289 is what we projected using our return on equity projection model. If we take the average of these two, we get a conservatively estimated future price target of Google in 10 years' time of $327. $327. Now, what we can do is we can compare that to the current price of Google and see what our rate of return is going to be. So what I can do is we can look at the current price. So if we look at Google's current price is $91, we can divide that by our future target price. So our future target price is 327 divided by 91. That gives us a 3.6 bagger, as I like to call it. 3.6 bagger. So I have my phone because I have the rate of return calculator on it, and I will give you the numbers. So if we say that Google is currently at 91, and in the future, in 10 years' time, it'll be trading at 327, That gives us an annualized rate of return of about 14% per year. So what this is saying is that if these two models triangulated give us a good estimate of a future price of $327 per share, and Google is currently trading at $91 per share, then our rate of return would be 14% per year on this investment, using only these two models. In addition to this number here, which is simply from the rate of Google's earnings and so forth, we also have to look at what returns we're going to get from dividends, as well as our returns from share buybacks. And that is called the net common payout yield, which combines dividends plus share buybacks. And we can see that Google has been averaging over the past 5 years about 2.2%. So in addition to this 14% return, we also get a 2.2, and this gives us a future rate of return of 16.2%. Meaning, if we were to buy Google now, we would predict that our annualized rate of return would be 16.2% per year, or let's say 16%. There's no point in using decibels, really, in using these methods. But we're not done yet. Now that we have this rate of return, we have an alternative method that we're going to use using this return on capital projection model that'll give us another percentage over here that we can then compare with this and see how accurate it is. And I'll do that right now. So now we're on to our third and final model, which is our return on capital projection model. And what we're going to do using this model is we're going to look at what Google's able to reinvest and what rate of return it's able to get on its reinvested dollars. So in order to do this, we have to take Google's return on invested capital. Google's return on invested capital is about 25%, but if we use the average over the last 5 years, we can say that Google returns on its capital about 20% per year. We're going to divide this by, so it's return on capital or return on invested capital, by Google's weighted average cost of capital. Google's weighted average cost of capital, if you look it up, you'll see that it's about 9% roughly. So what we're going to do is we're going to divide Google's return on invested capital by its weighted average cost of capital. So 20 divided by 9 will give us a reinvestment factor of 2.2. Now what we do is we take Google's earnings, so it's net income. So we can look net income trailing 12 months. 67 billion. 67 billion we multiply by this 2.2, so I'll show you here, times Google's net income. So remember, this 2.2 we got by dividing Google's average return on invested capital by its weighted average cost of capital. So Google's return on invested capital is 20% on average. We divide it by our weighted average cost of capital of 9%, which is Google's weighted average cost of capital that you can look up, roughly 9%. And we get a factor of 2.2. So 20 divided by 9 gives us 2.2. We multiply that by Google's net income. Google's net income was 67 billion. So 67 times 2.2 will give us a number here. So times 67 will give us a value of 149 billion. 149 billion. So Google's net income times this factor here, which was determined by dividing Google's return on invested capital by its cost of capital. So 67 times 2.2 gives us 149 billion. We take this number and we divide it by Google's enterprise value, which we can look up. Google's enterprise value is let's say 1,081 billion. So 149 divided by 1,081 billion will give us Google's growth rate of return. Google's growth rate of return. So we take this number, 149 divided by 1,081 billion will give us Google's growth rate of return of 13, or let's say of roughly 14%, but 13.8%. 13.8%. So as you can see here, look how close these two numbers are. Using our earnings per share projection model and our return on equity projection model, we calculated that Google's future price in 10 years' time would be $327 per share. Compare that to our current price, that gives us a 10-year annualized rate of return of 14%. Now, using our third and final model, which is a return on invested capital model, we determined that Google's future rate of return on growth would be 14% per year based off its current enterprise value. So look how well these two triangulate on one another. The combination of two models gave us 14, and a third model gave us 13.8, or basically 14%. So both of these models are saying Google will return 14% on growth. Now we have to add to this number here this 2.2, which, if you remember, was Google's their rate of share buybacks on average over the last 5 years, plus their dividend yield, which is 0 for Google. So plus 2.2, that gives us, this will be 14, 15, 16. This will give us 16%. What does this mean? This means that if we compare these two, we can see that roughly Google is anticipated to give us a 16% annualized rate of return. Therefore, if we were to invest in Google now, we would anticipate that they would give us a 16% annualized rate of return over the next 10 years. We compare that to alternatives like investing in an index fund, and we will get a good sense of what Google's rate of return will be to us as investors. And we want a good margin of safety, so if an index fund is going to give us 10% per year, this will give us 16%. It seems like a good margin of safety to me. I hope you enjoyed the video. If you have any questions, please ask in the comments below. I hope you never have to do a discounted cash flow model again. I'm not saying discounted cash flows are horrible, but there's definitely better alternatives out there like the model I just showed you. So please like, please subscribe, and if you have any questions, leave them in the comments. Thanks.